Good morning, ladies and gentlemen. So this is certainly one of the best conferences in Switzerland, and there are less people, so it looks like a bear market low. At least it feels like that in my portfolio, if you see what I mean. I think we've all gotten pretty bruised. So one thing happened 2 days ago. A very famous figure of the gold mining scene, the famous newsletter writer Richard Russell, died, age of 91. He was an amazing character living in California. Some of you probably subscribed, like myself, for decades to his newsletter. And he is an amazing character. In the 40s, he was flying over Nazi Germany in a B-25 bomber and bombing Germany. It was a little rougher at these times than Paris a couple of weeks ago. He saw most of the gold moves. He was one of the first to call the 1960 bull market in gold. And one of his favorite saying, I would like to start with this, because we have to remind ourselves of the basics. The wealthy investor puts his money, let me get my time here. The wealthy investor puts his money where great values are. And if no outstanding values are available, the wealthy investor waits. He does not mind waiting months or even years for his next investment. So probably I was a bit impatient and I didn't wait enough on the gold mines. But we're certainly seeing value. Oops. So we've experienced basically a 2932 collapse, crash for the gold mines. My friend Tom Kaplan, who hosted a dinner party at the conference in Colorado, described this as that we went through a nuclear winter. And I think that's certainly the case. So the gold bear market in US dollar is down. We're down 40% from the highs. Every time something happens, gold goes down. So more QE in Europe. This should be very positive. And gold goes down. So according to Beld, who's a very good analyst that you probably know on the gold scene, he explains this, that more QE in Europe, dollar goes up, gold goes down. Of course, these types of correlation, they last what they last. The correlation with the dollar has been going on for about 10 years. But as us long-timers know, nothing really correlates long-term with gold. So sometimes gold correlates with oil for a little time, and then sometimes it correlates. But the inverse correlation with the dollar has been going on for 10 years. One day this will also cease. Rate hike talk, gold goes down. Now, who cares if the Fed raises rates 0.25%? It's not going to change anything to the economy. We all know that. But the market is focused on that. And since we've had these rate hike talks, gold has corrected. Now, this can be probably something comparable to what happened with the taper tantrum. People were talking about tapering, gold went down and down and down. Now, when the fact arrived, we had a rally in gold. And I believe we're going to be in the same type of situation. Once this is out of the way, gold can go up. And recently, gold has been a little more, less, going down less quickly, let's say. So the consequence of this terrible bear market is that all participants of this industry have lost all credibility. Brokers have touted all these stocks which went to zero. The CEOs of most of the major gold mines have been fired, and we know the reason why that happened. All gold funds are down drastically, and we've had investor capitulation. And for all the asset allocators, basically we're now down to 0% asset allocation in gold and gold mining. So the question is, do you still own gold? So maybe we can have a little quick survey to see how everybody's positioning. So could those who own who own 10% or more than 10% in gold and gold assets, gold stocks, could they raise their hands so we have a little idea of what's happening here? So we have, not too many. So another question then. Who believes that gold in 6 months will be higher? Please raise their hands. So that's half the room. And who believes that gold will be lower in 6 months? Little third. Okay, so plus the lady, it's a little more than a third. It's nice to have a beautiful lady in the front row. Okay, so now I'd like to introduce to you a very important newsletter writer and private investor. His name is Dominique Frisby. He's from London, and he's going to do the most important talk of this my little presentation.
Press play, Claude.
Where do I press play?
Yeah.
Thank you, Eric.
You're welcome.
The President of the United States.
Oh, baby. Yeah. Ooh, yeah. Listen to this. Mortgages, cars, consumer shite. Government spending all through the night. Pensions and healthcare and welfare rights. Education wars to fight. Ooh, I love a good war to fight. Run up a deficit, ignore the facts. Blame someone else, put up tax. I can't deny we had a crack, but now we gotta pay it back. You know what you are. You're dead bomb, dead bomb. You're a dead bomb. The addiction to credit just goes on and on. Give it to dead bomb, dead bomb. You're a dead bomb. A bailout, ooh, you turn me on. You know what you're doing to me, don't you?
Yes, he sure does.
If you can't afford it, don't be ill at ease. No? Spend it anyway, you've got voters to appease. Take the prudent savers and just give them a squeeze. Ow! That's the economics of Keynes. One more time now. Quantitative easing, zero interest rates. Steal from the future, hide the bad mistakes. We gotta keep those asset prices high. Don't matter if the credit's dry. Dead bomb, you're a dead bomb. Try to pay the debt off with inflation. Dead bomb, yeah. You're a dead bomb. Malinvestment, ooh, you turn me on. A boom caused by excess credit will always bust. Yeah. You've then got two choices, decide you must abandon the addiction of credit lust, or the currency collapses, it just turns to worthless dust. Yeah. Dead bomb, you're a dead bomb. Destroy the country's money, anything to carry on. Dead bomb, you're a dead bomb. Bubbles, ooh, you turn me on.
Claude. I'm the moderator.
Well, I tell you, I can't beat Dominique Frisbee. Since I've been in Switzerland, I started to learn how to dance salsa. Everything I can do to avoid depression because of the stocks going down, I'm trying. But so anyway, the question is, after this collapse, is gold really still a safe haven? And when anything goes down that much, we're in doubt because we've been disappointed. Gold didn't protect us in these circumstances. It didn't protect us in another circumstances. So is it still a safe haven? The answer to me is obvious, because when the crises are really big and that you really need the protection, then gold has never disappointed. So if you take the example of Russia, the gold in Russia is up 81%. In Argentina, it saved a lot of people. And if we're any doubt, we should take the phone book, call up any guy in Venezuela today and ask him what he thinks of gold. So gold is still a safe haven. Consequences for investing. It's very clear that we're living in uncertain times, and whether it's political, economic, or whatever, there are some problems out there. So since there's all these new techniques, we're in uncharted territory for the QE, the low interest rates, the negative real rates, this and that. And it's always so difficult to predict the future. I think a prudent strategy is to keep diversified, maybe more diversified. Now, the problem is that the key asset classes are becoming much more riskier. If you take bonds, they've been going up for 30 years, so we know there's not much potential there, and there's huge danger. If deflation continues, maybe we can have one more leg up in the bonds, but who knows? As for shares, they've been going up for 6.5 years. If Richard Russell was around, he would tell you that we've had just recently a Dow theory non-confirmation. It means that the uptrend is not clear because the Dow has made a new high, but it was not confirmed by the transportation. So if we break below the recent lows on the transport and the Dow, then you have a bear market signal and you should be out of shares. That is Richard Russell's idea, is that once you have to respect the basic trend of the market. If you take real estate in the mind of people, it always goes up. Now, we know it's not true. In the 90s, real estate went down something like 50% in France. And I think in Switzerland it's been pretty dramatic also. And today, real estate is starting to roll over in a lot of countries. High-end real estate in London, as you know, is down 11%. High-end real estate in Switzerland is already down. Now, cash is very suspect. In which currency are we comfortable? We know that all fiat currency, they go to zero. Here are a few examples. I personally went to Zimbabwe at the beginning of hyperinflation, so I have a first-hand experience on what it means. When this thing starts, it's devastating. So if you take the case of the US dollar, people say, the dollar's going up, safe haven status. What safe haven? How can a nation with a huge trade deficit, with massive debt that will never be repaid, how can that be considered as a safe haven? Is the yen any better? Is the euro any better? Not so sure. As a Torney person puts it, governments create money out of thin air with no intention to repay the debts. So based on common sense, cash doesn't look like a fantastic alternative also. So this is the position we're in. The emperor has no clothes, but people don't see it yet. I want to show you something. I took the train this morning. It's rather practical, and they run beautifully in Switzerland. And this is today's newspaper. Il repeint la zone bleue en jaune pour se garer. Futé, gonflé ou naïf, un habitant de Moudon s'est approprié une place de parc de la Grand-Rue. Il a recouvert de jaune les lignes bleues d'une case de stationnement. La supercherie n'a pas échappé à la police, qui a fait boucler le périmètre. Rather amazing. Now, of course, we laugh when we hear this, but when the US government gives their inflation statistics, everybody believes them. And even the very sophisticated money managers, who of course know that the numbers are fudged, they still use them in their calculation. Now, why do they do that? Because everybody else is doing it. So in order to be able to predict, you have to use the wrong numbers everybody is using. The wrong numbers on interest rates, the wrong numbers on inflation. So we are in this position. And I think that everybody who is today here in this room have the amazing advantage that they can see what others make believe not seeing. And this should be hopefully very rewarding. So I would say that for most customers, you have to go back to the Swiss banking common sense, which was to have 10% in gold or gold-related assets. Not so easy to implement because there's this performance thing. People look at their performance, they don't want to see anything going down, etc., etc. So I don't know how you resolve that. Maybe you can, with the agreement of the customer, maybe you put gold and gold assets in a separate account, like a little insurance policy in case of big disruptions. But basically, it's a matter of common sense. All the usual assets are expensive, so you sell a little stocks, you sell a little bonds, you sell a little real estate, you get out a little of cash, and you increase the gold pocket. How do you do that? The most easy way is to buy these ETFs, GDX, 53 basis points, GDXJ, 55 basis points. So that's the easy way to do it. But of course, for customers, it's probably better to buy funds because once the customer is in the fund, it's for the long term. And if it goes up, the temptation to get out quickly will not be there. And probably this will ensure better long-term performance. Especially you have experienced money managers like Gold 2000, Eric Meyer, who is going to talk this afternoon. Be sure to listen to his talk because it's a great. He's done a great job. Alain Corbani, who was a keynote speaker here at several conferences, just like Eric Meyer, these guys have been through the cycle. They have outperformed the index, so it's pretty much of a no-brainer. And of course, buying shares with staying power. Shares are at historic lows, and also the quality of the companies are much higher. The advantage, if there's any, of a bear market is that it cuts off all the weak companies. This is the function of capitalism. So we are, in my mind, still in a secular bull market. And we've had a big correction. It's a 40% correction. This is not something unusual. If you remember, in the bull market of the 80s, gold had run from $100 to $200. And everybody was happy. Everybody was climbing on board and buying at 150, 160, 170, 190, 200. And then, boom, the price goes down 50% to $100. Of course, most people sold at the time because it's, you know how difficult it is to stay on board in a real bull market. And in the perverse nature of markets, gold flew and went to $835.
5 minutes, Claude.
What?
5 minutes.
5 minutes. Okay, so gold is already rising in most currencies. It's up 81% in ruble. It's up in Australian dollar. In the euro, none of my French friends are aware of that, but gold has outperformed their bankers. It has outperformed their fund managers since the end of 2013. Even in the Swiss franc, from the lows, we're up 6.5%, which is better than negative interest rates. So for me, if you reallocate money, of course you have to have physical gold, but the huge opportunity is in gold mines. They're down 90%. This means that they are at 20-year lows in terms of price to cash flow, price to EBITDA. So we're talking about real value here. It's not going to feel good. If you buy some more mines and you have an upset stomach, you know you're on the right track. It feels great to be invested in Apple. I'm on record in another Bailly conference to have recommended shorting Apple and buying gold stocks. The first is starting to happen. Hopefully the second leg will work also. Huge base on the GDX. We've had 2 years of huge tax selling. So my assumption is that we will not have a huge tax selling problem this year. A stealth bull market is already up. Here are a few companies presenting here. They're in basing formation or clear uptrends. And leverage is back. Costs are going down. This year they'll be going down 10%. So the CEOs are finally starting to do their jobs. There will not be dilutive acquisitions. And in terms of behavioral things, you can be sure that the CEOs who have seen former CEOs get fired because they did not respect, they did not control costs, this time around, even if gold goes up, it's going to be a long time before they let the cost go up too much. So now is a good opportunity to accumulate. The leverage is huge. If you take a huge stock like Nova Gold, even that, if gold is multiplied by 2, it can go up 20 times. If you take Victoria, a sophisticated model from Sun Valley, calculated at today's gold price, the theoretical value of Victoria is something like 14 cents. At $20, at $2,000 gold, it would be $20. So taking, well, that's a little clin d'oeil on Argentina. Pan American Silver, as you know, has a big asset there in Argentina, and it could double production. It's not in the price. So it's not because a stock is down that it's not a bad that it's a bad stock. That's pretty obvious. And I think we should respect the key investment rule, which is to buy low and to sell high. If we do that, this is the type of rewards that happened after 2008. Victoria, that I was mentioning, went from 9 cents to $1.50. If we capture half of this or a third of that, we'll have exceptional performances. Okay, well, thank you very much, ladies and gentlemen. It was a pleasure to be here, and I hope I'm just in time.